Welcome to the high seas, everyone. Portfolios are out here getting trashed, but we have to hold steady and weather the storm and come out on the other side like we always do. These are the times when you need to have conviction in what you hold. It's easy to become a cynic during month long down moves like this when volatility and uncertainty are rising and no one has a good idea where the overall market is going because of all these spicy macro factors. But remember this: cynics know the price of everything but the value of nothing. Do one of your periodic checks of your fundamental analysis and reassure yourself that what you hold has true value behind it and a story future to be excited about. In this video, we're going to cover a macro recap. We're going to go over the markets. We're going to go over notable stocks. We're going to hit up the mental dojo, and we're going to go over the 4 pillars of investing, the pillars of what we're trying to work on with these videos. This video is pretty visual, so it might be tough to listen to if you're on the road. So I'll do my best to explain what we see on the way. So just want to show you real quick, this was the market on Friday. Overall, it pulled up a little bit. Google here saying, screw your reversal. I'm popping off right now. Everyone else is getting a little breath of air for once, while the chips over here are hanging out right below the surface. Moving on, something else I want you to see is the market since last week. This is the market since last week, guys. It's over a 1 week period, and you'll start to notice it's looking like Christmas up in here. A lot more bright red, especially in your mega and large cap stocks. And Amazon, Nvidia, Tesla's not looking too hot, but not Google and not really healthcare here. You see all that healthcare there. Typically, healthcare is deemed a safer place to cycle your money into in these downtrends, so you can obviously see that with the green over here. And one more thing to keep in mind. This was the market on January 1st, 2025. It's really easy to lose sight of how much everything is up overall right now since the beginning of the year. I mean, just look at this. Nvidia's up 33%. Broadcom's up 46, AMD's up 68, MU, what the 146%? I mean, all the financials are up, all the healthcare is up, Google's up 58%, Amazon, it's about the same. But yeah, it's really easy to forget that we're actually really high up from where we started at earlier this year. And so I wanted to go over this really quick. This is data from FinViz on Friday. It's just showing that more stocks are advancing over declining right now, but only a small few are getting at new highs. Very small few. In fact, I'm kind of surprised it's even that much right now. Not many stocks are above their 50-day moving average right now. Only about a third. Actually, no, yeah, a third are below their 50-day moving average right now. And about half of all stocks are below their 200-day simple moving average. This in particular is important to keep in mind as we're going to talk about it a little bit later. I really wanted to show you this. It's something that I found on the weekend. And really what this chart shows is the stock price in blue here has been in a long-term uptrend, but recently is starting to roll over. You see the volume ratio, and this is all talking about SPY put and call ratio. So it's put to calls, which if you're aware of what this is, it's kind of a good indicator of which way the market's flowing. Or is it going more towards bearish sentiment or bullish sentiment? Can give you an indication a little bit how that's happening. Not so much as why it's happening, but how it's happening. And so the volume put call ratio here in green has, you see, oscillated around over 2025, but it just recently started going up again. And it's been oscillating really around 1 with spikes above 1.2, which indicates some fear. When the put to call ratio is going up like this with volume flowing in, that means that more people are buying puts than calls right now. And so when people are buying more puts than calls, this can show that there's some fear in the market. The open interest ratio means that people are trying to position into puts versus calls. And so when you look at this, you can see that this has steadily risen throughout 2025, now sitting near 2 up to around 2.4. And it also means that there are twice as many puts open versus calls waiting to get filled. And so the interpretation of this is really that the price is weakening while hedging demand increases. Rising open interest on the put-call ratio does not mean an imminent crash. It usually means institutions are hedging, setting up their positions for the hedge, and they're pricing in uncertainty rather than panic. The volume ratio remains pretty stable, so really no sign of capitulation right now. And so despite the S&P staying in a long-term uptrend, the options market is telling a different story. Open interest put and call ratios have climbed all year. That's institutional hedging and not panic. It says, so we're still bullish, but we're not taking any chances. That's kind of what this shows. So I know this is messy, but I want to draw your attention to a couple of things here. As you can see, this is talking about SPY options, SPY. And the first thing I want to draw your attention to is how many calls were bought on Friday versus how many puts were bought on Friday. This is the total volume of calls to puts. The put to call ratio on that one day, about 1.45, which is pretty high actually. Put to call, that means people are really starting to buy into puts right now. There are a total of 5 million calls and 11 million puts. So the puts are 2.2 times higher than the calls right now. The implied volatility and the historical volatility are both pretty low right now. So what's the interpretation of this? Traders are buying, holding puts at elevated levels while volatility remains relatively low. This is classic positioning before major macro data such as CPI, shutdown stuff, Fed policy signals, etc. So when IV is low relative to fear positioning, the market is primed for volatility expansion. So the option markets are loaded with puts right now, over twice as many calls, but volatility is still sitting at the floor. That combination is like dry grass in a forest. It only takes one spark for volatility to explode. And so let's get into some of these macro events. The US government shutdown breakthrough. On November 10th, global shares surged as investors reacted to a vote in the US Senate advancing a funding bill aimed at temporarily ending the 40-day long government shutdown. So markets like the FTSE 100 hit record highs and US futures rose at that time. However, the risk, while funding appears close, many analysts caution underlying economic damage from the shutdown, such as delayed data, consumer confidence, plus the same issue is going to come back in January. This is all adding uncertainty to the market and it's causing that further hedge positioning. So why should you care? Ending the shutdown removes a major liquidity and risk overhang. This can tilt capital back into growth assets and reduce fear premiums. The US-China trade and rare earth developments. While full details remain in flux, recent developments include easing of certain Chinese export controls on rare earths and other materials subject to one-year suspensions. That's a good thing. Markets interpret this as a possible reduction in strategic supply chain risk, especially for tech, EVs, and defense sectors. So why should you care about this? If supply constraints ease or risk of escalation reduces, companies in the AI, semiconductor, battery, and critical mineral space gain more upside. Oh, Jesus. According to a weekly macro review, the US economy remained resilient through mid-November, with GDP expansion around 3.8% in Q2, and markets expect modest or declining interest rates ahead. Still, there is some uncertainty over the results of the mid-December rate cut decision. The government shutdown, it halted certain economic data releases, which heightens uncertainty about the true state of the economy. And so why should you care? I'm here at the Fed right now. Why should you care? Strong economic data gives more runway for growth assets, but data blackouts due to the shutdown increase risk and may result in surprise moves by the Federal Reserve or markets. Guys, the bulls and the bears, they're duking it out on the Capitol lawn with investors pulling back from growth stocks on a risk-off rotation. Growth equity funds saw notable weekly outflows. Investors started moving into value and defensive sectors ahead of still unknown CPI and Fed updates. And so why does it matter? This is a classic pre-data risk-off move, a setup for sharp reversals once uncertainty clears. Growth valuations, especially AI, cloud, and semiconductors, can become temporarily dislocated, giving long-term buyers discounted entries. Super important. This is a really important moment for investors. You have to really utilize high conviction when others are hesitating. So guys, it's market time. Let's get into some of the charts here. One other thing I really just want to let you know, I like to look at the markets a week ago and today. And the reason I like to do that is to see what changed over the week. So if you're able to look at the screen, it really helps, but I'll try to explain as we go along. So starting off, we got the VIX. You can see a week ago, this was back kind of around November 16, 17 there. We were back around 20. You saw that tried to jump above 20, but then went back down. VIX was flirting with little volatility pops based on macro factors and valuation concerns, with some sectors in the economy appearing to be bubble-like. However, not all. Currently down below 20, which is a good place to be. That was right where we left it last week. And so this week, popped way up. But you see this? Volatility is going up and down and all around on these candles. By the way, this is a 1 year, 1 day candle. And so each candle is 1 day. And so huge volatility spikes this last week. This is something really important I want to point out here. And you're probably wondering why I got peanuts and pistachios on this chart. First thing I want to explain is this uptrend, or this channel. So the middle pink line is the linear regression for this time period. A good way to think of this is generally this is where the price most likes to hang out. The two yellow lines there in between, right here and right here, these are kind of 50% out from that line compared to the wider channel. Most of the time, certain percentage of the time, it's going to be within these two bars. So as you can see, over since April, it stayed between those two bars. However, just recently with all this volatility, it's dipped down into what I like to call the peanut zone. And the reason I call it the peanut zone is because you're basically buying the prices of your pistachios are starting to look like peanuts. So it's good times to buy. Whenever you see the price of something go below this yellow line on the bottom side, there could be a pretty big reversal if you believe in the uptrend. So yeah, never forget, this right here is the place where you can buy pistachios for peanut prices. QQQ also having some volatility jumps around here, up and down and all around. That was last week. This week, even more volatility spikes. Look at this giant red candle. The small caps, this was last week, is starting to fade a bit. And oh yeah, it kept fading. Bitcoin, oh Jesus, our poor, poor baby Bitcoin. This was last week. It was sitting out around the low 90K there. And so this week, oh Jesus, oh God, it went all the way down to this bottom level here at mid 80s. And so we'll see where it goes from here. Not looking too good for Bitcoin. And so Ethereum, this was last week, kind of hanging out similar to Bitcoin in a decent range there. Maybe a chance reversal. Nope. It also dipped off. The dollar, this was last week. The dollar was around 99. Actually gained some steam there. If you see, I'll go back. You can kind of see, got a little boost there. Gold. So gold, I know in a couple videos ago, I was saying how gold was going up so much. Who could ever take this thing down? Well, it actually came down a little bit and then it's coming back up and now it's bouncing around. This week, more of the same. Still bouncing around, still figuring out where to go, which could be a signal that potentially gold might be overpriced or people are not as ready to rotate into it as before. Crude light from last week to this week went down a little bit. Not great for the economy. Copper, this is a general sign of, it can also be a sign of how the economy is doing. Stayed about the same. No big changes there. The tech sector did not have a good time this week. Look at that giant red bar. Not pretty. This is utilities. I tend to like to look at this because it's generally a sector where people will park their money. You can get decent dividends from these stocks. They're very stable. People always have to pay their utilities, so the cash flows are there. It can be an indicator for how risk on or risk off people can be. So this week, it went down a little bit. People are in this weird spot right now. They don't know whether to go back into the growth stocks or whether to park their money. Nuclear. This is the industry for nuclear stocks. I like to look at this because it helps me think of how risk on people are in a way. Last week it was here. This week dipped along with the overall market. Now getting into the Mag 7. Nvidia had its earnings. So this is the chart from last week before the earnings. You can see it was in a good spot, kind of in that range where it's safe. This week had this huge fake out. I think everyone's ankles were broken with this one. Looked like it was going to carry the whole market back up. And then it pump faked and then went down to this lower level. We're going to see if it keeps going lower below the 170s. Might be a good place to pick it up. Tesla finally broke that trend line on the downside. Looked like it tried to fill the gap and then make another decision if it wanted to break back to the upside. This was last week. This week, we're kind of staying in that gap. Maybe we're filling, consolidating. We'll see where it goes. Google, one of the most interesting moves this week. This was last week. We're in a good place. We're in the 270s, but we found out that Berkshire Hathaway put in a ton of money into this stock. And so it started jumping back to the upside and it's moving on its own like it wants to get out of the house after finally getting into college. Meta. Now this is one that I really want to talk about because I think there is a lot of money to be made for retail here if you're paying attention. And so this pink line is the linear regression line over a 3-year period. Okay. And I'll show you an image of that in a second. We are pretty far below that. In fact, You see, we could actually maybe parallel it from April, back when we were on the downside there. This is Meta this week. Pretty much more of the same lows. We're just kind of hanging out down there around 600. Now, this is the zoomed out chart. So, just to let you know, this is a 1 year, 1 day chart. All of these charts have been 1 year, 1 day. But this chart is a 3 year, 1 week chart. So each candle is 1 week. So as you can see, this trend has been going on for 3 years now. Linear regression has pretty much held strong for over 3 years. And so we're on the downside there, like I said, with that parallel line compared to April volatility. As you see, the further it gets away from the linear regression line is generally where we've had more volatility. So let's add some channels to this because I want you to see this generally where things are, right? I know there's a lot going on here. So as you can see, as I explained earlier with SPY, this lower portion, this is where the stock does not like to hang out. It does not like to be in this bottom channel here below the yellow line. Generally, this is where you'll start to see some volatility moves like this, where you see these big red, green candles until it makes a decision where it wants to go. Currently, we're right there. We're right at the decision point. So we're going to see where some of this is going. This might be a great time to buy unless you feel like a big reversal in the market is about to happen and we're going to break lower. However, I think that this is a great time to pick up Meta, and we're definitely in the peanut zone. Don't forget, this is where you can buy pistachios for peanut prices right in here. Amazon. So this is last week. It was doing well after earnings, having some trouble kind of breaking up and then, kind of retesting its support. Let's see what happened this week. Dang, it broke back down into the same channel where it's been for really the last 5 months. I'd say around 200 is a good support level. We'll see where it's going to go from here. AMD. So you're probably looking at this chart and thinking, what kind of dark magic is this guy trying to use? And I just want you to know you're absolutely correct. I'm doing a lot here, but I just want you to see something really important with this stock. And it's because I do so much with this because I think this has some of the most potential in the market currently. And so you can see, same concept. This is the linear regression channel going up over the last 7 months since April lows, where it had that final turnaround. I know I talked about this in a previous video, but you can even see here, it hit the bottom of that linear regression channel on the downtrend, finally made the reversal, and it's been following that linear regression line. Pretty much the average of all these prices, it's been following that and respecting it for the last 7 months. And so this was last week. This is this week. We really tanked with the overall market. But as you can see, we're back in the peanut zone. And the peanut zone is money, right? If you believe that the trend is going to continue and you have pretty good conviction that things are going to turn around with some of this uncertainty clearing, then now is a pretty good time to start buying. We might have a little more downside, as you can see here. I don't think that we're going to go really below the 190s. Might hit like 190s, but even 200, breaking that to fill the gap, something that could be happening. We'll kind of keep an eye on it this week. Now I want to give you a system which can answer a question that's really important to know, especially right now, is this move a trap or is it real? And with this system, which is a combination of about 5 indicators, we can take a closer look at this. These are the 5 indicators that we're going to be using. The first one to look at are the simple moving averages here, which are the roadmap, shows you the short-term, intermediate term, and long-term trends. The second one to look at is the advanced decline line, which shows the number of cars on the road. So what number of stocks are participating in the move? The next is the rate of change, which is the momentum in a certain direction. With this, we can see when the price is going up, how fast is it going up? What is the acceleration of it? And if it's going down, what's the acceleration of it going down, the price? This is really the gas pedal of the trends. And so the next is the Bollinger Bands, which I put as the road conditions. Whenever the price gets close to one of these, you can expect volatility to soon expand. Also, when this converges, you can also expect a volatility expansion pretty soon. The next one is RSI. It's the temperature of the engine. You can see if the market is overbought or oversold, and whether the price is going to keep going in the trend or if we can expect a reversal. So let me show you some examples of this. This is SPX from about a week ago. You'll see the green line here is the advanced decline line. This gray line is the cumulative advanced decline line. And so you can see we're in an overall bullish trend, which has continued. The light blue line is the 20-day moving average, and the orange line is the 50-day moving average. The light purple line down here is the 200-day moving average. And so, like I said, you can see we're in an overall bullish trend. We've dipped below the 20-day simple moving average and are hanging out around the 50-day moving average. Some other points here are the red line up here is the upper Bollinger Band, and the pink line is the lower Bollinger Band. So you can see we're down near the lower Bollinger Band there. The rate of change just dipped below 0, which means we're increasing in acceleration going downwards. And the RSI is sitting right in the middle, so it's not in an overbought or oversold condition. So moving forward to this week, more moves on the downside there. Well, you'll see that the advanced decline line came down, price dipped below the 50-day moving average. We're still in a bullish uptrend. However, we're fighting for that 50-day moving average right now. Because the advanced decline line came down, that shows that less stocks are moving with the trend overall, since there's some divergence there. And because the price is still at the lower Bollinger Band, we can expect some volatility expansion pretty soon. You'll also notice that the rate of change is down there pretty low, which means we've accelerated pretty quickly to the downside. However, not too far, as you can see with the April tariff situation, where we dipped below -5 there. We're also still in a decent place with RSI, but on the lower end. And so overall, that's how you use this system to tell, is this move real or a trap, and give you a general idea where the market's going to go next. One other thing I wanted to show you quickly, which is utilizing the linear regression channels once more. This is SPY from this week, and so I just wanted you to see that SPY is flirting with the peanut zone again, which it hasn't done this since back in April. So if you believe, or really what this is answering is, if you believe that the uptrend is going to continue, or if you believe that the next few weeks is going to start a reversal, then this is the time to buy. You're right down here in a channel which it never spends time in. It hasn't done this in the last 7 months. So keep that in mind. So everyone, welcome to the Mental Dojo. This is where we're going to work on your mindset a little bit and get you ready for these times in the market where everyone's losing their mind. You're going to be zen. So I want to tell you a story now about a person named Ernest Shackleton. So in 1914, Ernest Shackleton's ship was swallowed by the Antarctic ice. 28 men were stranded on a frozen ocean with no rescue, no radio, and temperatures 50 below zero. Every day felt like waiting to die. His crew had two choices: to stay on the ice and cling to the illusion of safety, or climb into a tiny lifeboat and attempt an 800-mile voyage through the most violent waters on Earth. Shackleton chose the terrifying path with real upside, and because of that decision, every single man survived. Shackleton and his men didn't escape uncertainty. They learned to act inside of it, and that's where you and I face the same two choices. So guys, I'm going to give you a spoiler for the rest of your life. Is that every single morning you wake up, you're going to face uncertainty. It never goes away, it just changes shape over time. And once you accept that, you really only have two choices in the way that you act. And the way that you act and the way that you react. You can either, you can take this path, and you can let uncertainty and the anxiety that comes with it control your decisions, pushing you subconsciously towards the illusion of safety and certainty, the place where growth quietly dies. Or you can learn to recognize and appreciate what's truly valuable, even when it feels uncomfortable, even when it goes against what everyone else is saying, because that's where all meaningful progress begins. So let's leave that for us to think about this week as people are losing their minds in the market. Mastery is not choosing the path with less risk, it's choosing the path where risk pays you back. And so guys, as we go through these videos, these are the 4 pillars of what we're working on to become the ultimate trader. We're working on psychology, building a growth mindset, making sure that our ideas are backed by data and logic, and then also building a process which can sustain itself and a system which is going to make you tons of money over time and ultimately help you build connection, mastery, and be able to contribute more in your life. Everyone, I appreciate you joining me this week for some fun downtrend action. We talked about macro factors to include the US government shutdown breakthrough, the US-China tensions easing, data and monetary policy signals, that's a fun one. the risk off rotation going on in the market right now. We went over the charts, we hit up the mental dojo, and now it's time for us to make some money. Let me know in the comments your thoughts about the next market move, and I'll see you all in the next one.